Price per square foot is down. Interest rates are identical to 2023. Identical. 7.07 yesterday when I pulled it up. Crazy.
From the Blue Form Media Studios, this is the 435 Podcast, the pulse of Southern Utah.
Hey, everybody. Welcome back to another episode of the 435 Podcast. I'm your host, Robert McFarland. I got Brandon and Jeff in the studio with us today. We're talking real estate statistics. We give you what you really need to know in the first 5 to 10 minutes. Everything else we dive deep on. We talk mortgage interest rates. We talk tariffs. We really get into the weeds with some of this stuff. So if you're a data nerd or if you're thinking about buying or selling, you definitely want to listen to the whole episode. We got a surprise for you at the end. If you listen to the whole thing. Hope you enjoy this one, guys. We'll see you out there. Okay, we're talking real estate today.
Oh, boy.
We got the fast facts for those that are going to listen to the first 5 minutes and be like, just give it to me straight, Bob. What do you think? Is the market going up or down, boys?
Yes.
How much time do we have for me to rant?
30 seconds.
Ooh.
Are home values going up or are they going down?
I think over time, home values will always go up. Over time. Over a long enough period
In
of
the
time.
last 12 months, what has happened? Have home values gone up or down? There's a cheat sheet in front of you.
Mostly down.
Boom. Yeah, I think they come down a little bit.
5% appreciation, average price point. 6% on the median up.
Okay.
Hold on, let me double check that.
Is this in the last
2.5% on the median.
This is the last 12 months or year over year?
But you know what's interesting
Guys,
is,
you're going to have to listen to me slowly because sometimes I just say things.
When you
median sold price is up 3% year over year, year to date. So this is December. We're going back quarter four. We're doing quarter four.
okay.
So median is up 3%. Average is up 5%. $31,000. The average price sale in Washington County has gone up. I just saw a video the other day of the self-described most best agent in Southern Utah, most sales in Southern Utah. He said the home values are going down, which is not what the data says. It's not what the data says.
Well, I think there's an interesting dichotomy where if you have a newer home, it's catching some of that market appreciation. And if you have an older home where there was a premium being captured for that, now that it has to compete with newer homes, the price is actually correcting down.
Yeah, I think that's a good point.
On average, the price is still
that.
going up. But, homes that have deferred maintenance or issues, whatever it might be, or they're just less desirable compared to alternatives and newer alternatives in particular, I think those prices have come down.
It's interesting because the price per foot is down like $20 a square foot.
Well, I saw one. We have these laser markets, right? So I saw one
micro markets, laser markets, micro markets,
laser focused market,
laser focused micro markets.
Desert Color. I saw one that was it had sold cash in 2021 for $750 and just listed yesterday for $720.
Right, and then other ones in Ivans sold in 2022. It was like $730 and it just went under contract for $799.
Yeah.
Right. And so depending on the house, we've said this a million times, your house is unique. So if you're a seller and you're wondering what the value is, we can't make a blanket statement. Your home value has gone up 5%. The market has gone up 5% on average, but your individual house might not have, right? So there's some homes that are going down in value, some homes that have gone up in value. Price per square foot is down. Interest rates are identical to 2023. Identical. 7.07 yesterday when I pulled it up. Crazy. 7% interest rate. It's on the 30-year market. It's an index. So being able to say your interest rate versus my interest rate, everybody's interest rate is a little bit different because of how much debt they have, what's their credit score, all these different factors. But on the index, interest rate is identical today, 7.07% as it was in December 2023, the end of 23. So interesting start to the year. So interest rates have gone unchanged. Price per square foot's gone down. Average price is up. Absorption rate is slightly up. So it means how fast are homes selling on the market. So it's taking a little bit longer to sell. Days on market is up. New listings dropped below the sold number for the first time since December of last year. And then going back before that, it was the December of 22 that it did the same thing. Mm-hmm. So December always tends to fall down below, but it was significantly below the new listings Just not a lot of inventory hit the market in December, but we're about to see that change. Now we're in February. Pray to homes, spring selling season. Everybody's out of the holidays.
It's getting warmer.
They're ready to do it. Total sold. So we have 6% more sales this year than we did last year. So per our MLS, 4,047 homes sold in 2024 versus 3,800 homes sold in 2023, 6% up. And then new inventory is up 10%.
It's good news.
So that's good news. So we have increasing inventory, increasing demand, which is what kind of accounts for the increase in price.
It's good news for most people. Some people just want to complain that St. George is growing too fast.
It is.
And, I guess that's...
But growing versus number of homes sold, we still haven't built out. So, and we're going to get into that as well. Yeah. So if I was to give you the 30-second snapshot, that was it right there. Interest rates are basically unchanged. Absorption rate is up slightly. We're in a balanced market. Days on market is up. It's going to take you 62 days or maybe a little bit longer to sell your house. Average price is up. New listings, we have less listings, more demand. And total number of home sales, people are buying up inventory still. Nothing's changed. So that's kind of the general overview, but we're going to get into the specifics. So this right here is the price breakdown. So going back to what you were talking about, Brandon, about new home inventory. So these are the percent changes. So if you look at the top here, this month versus year to date. So the far right columns, if you're listening online, definitely jump on YouTube or click on the Spotify video to take a look at this. But the biggest numbers that jump out to me, basically anything under 250,000, less homes have sold. Surprise, surprise. There's just that kind of inventory is now gone in Washington County. Who knows if it'll return, but maybe. But the biggest number of home sales percent change was between 350 and 399. So 350,000 to 400,000, 19% more homes sold in 24 than they did in 23. But we had less homes sell between 400 and 500,000, about 12%, 11.8%. Less homes sold there. And then we had a big jump between 500. The MLS does this weird thing where it breaks down between 5 and 750. So I broke it down between 500 and 600,000. We had 659 homes sell in 24, 619 sell in 23, 6% increase, which is kind of typical.
Okay, so you guys...
So that's where the inventory is, right?
You guys deal with hands-on transactions way more than I do. Are you seeing at all any, like, in the macro world, we talk about like this lock-in effect, this potential lock-in effect where people aren't moving because they have these really sweet rates, right? Do you see that there's a certain price point where the lock-in effect or the desire to stay in your home is like more prevalent because they have a lower interest rate? Like, and like, I guess, so to be like really clear, like if two people have a 3% interest rate, is it more impactful or more important to the people in a $400,000 house to stay put, thus creating lower transaction volume in that than say people with $900,000 homes?
Yeah, I think you nailed it right there. It's like if they bought a house back in 22 for 400,000 and they're thinking about moving up, but they had this low interest rate, because you're talking about a move up buyer, right?
No, I'm just saying like in general. So if two people have an identical rate, one person's got a $900,000 home or $1 million home, one person's got a $400,000 home. Is there a difference in the thinking between like, hey, I'm going to move, whether it's to take a different job somewhere or, move across town or, whatever, right? Like whatever life circumstances that drive moves.
I think it depends. I think it depends on the equity position that they're in. And like, okay, so one example, you got two people that have the same rate. One's in a $900,000 house, one's in a $400,000 house. I would assume that if the house is worth $900K now, they probably bought it for 500, or 600. They probably have a couple $100,000 in equity. But the $400,000 house with the same interest rate, they probably have a significantly less equity position in their house. So the $900,000 house probably would be more inclined to move. But you also got to think it's someone with a $900,000 house probably doesn't have a loan for that much.
Yeah, I don't think it's a price point thing. I don't think it's a lock-in based off the value of their house. I don't think that's what it is.
You don't think there's like, I'm just looking at the discrepancy in transaction volume and price points and just wondering if that's playing into it.
Well, if you look at
Affordability
$1 million
is
to $2 million, we had 26% more homes sell in 24 than they did 23. Right? That could be a lot of new construction. Between 750 and $1 million, we had a 12% increase in home sales, and we dropped number of home sales below 500,000. So maybe that lock-in, like to your point, is basically anything over 500,000. They're not moving because they don't have a place to go that they can switch, right? They don't have the equity position to make sure that they can afford that next place that they're in. It's more of a function of what is their motivation for selling.
Okay.
I think it's a motivation, not necessarily what the numbers say, because even though we've gone through this period of high interest rates from basically, the beginning of 22 till now, we've been around 6% or above for basically the better part of the last 2.5 years. People are still buying and selling, right? We're still seeing people move, but what's their motivation for moving, and why people are moving in Washington County are different than why people move from Provo to, let's say, Orem or something like that. It's like they're moving for different reasons. We're a destination town, and so a lot of our inventory moves as either a second home or people moving here because they're leaving some other area that has a ton of equity, like California or Washington, or you name 50 other different areas of the country that they had huge appreciation, and now they want to move to somewhere like St. George, whether it's for retirement or a job change where they can work remote.
What do you think the demand push has been in the county from your guys' perspective with some of these employers that are offering, I think, like more reasonable paying or high paying jobs, like some of the tech companies in town, right? So they're bringing talent into St. George. And, but that talent is still oftentimes like, it's a good paying job, but like, I mean, nowadays, right? Like a good paying job, you're not buying $1 million house. Like that's, you know what I mean? A good paying job as a young professional, you're still buying what I'm going to like air quotes here.
Between 750 and $1 million, probably.
Regular family home to a certain extent, right?
Mm-hmm.
Like, and so what does that growth into town do on different price points? You're saying those people are pushing the $700,000 bracket on average. That's where you see those buyers.
I think so.
Land?
Yeah, I think so. And I don't know if we've really hit an employment number for those higher wage jobs that are local.
We need more.
Yeah, I think the
more.
number of jobs has increased, and it's still coming. It's like this build up as Tech Ridge gets built out, and a couple of these other businesses are growing. Like I know for certain Zonos, they had these big plans of doing a big hire on, but they haven't hired on as many as they previously had projected.
Talk about a business that is probably going to be really busy the next couple of years.
I know, Tariffs, right? Yeah, exactly. I was thinking the same thing. And so when I
can
think
speak to that actually.
I know you guys do their
info.
You guys do their
We've
podcast.
Been there every morning this week with a new podcast so far on Trump's tariffs.
He's like, hey, we're doing tariffs. Just kidding, we're not doing tariffs anymore. Hey, we're doing tariffs again. Just kidding, we're not doing tariffs anymore.
By the time we stop the recording, it's like already out of date. They were laughing at it. They're like, yeah, we left the studio and it was like already not relevant.
Already changed.
Moving.
It's crazy. So I just don't know if there's a big enough job change. I think people are coming here working jobs from other areas that are improving the pay. Private wages, weekly wages has gone up 16% year over year, which I was looking at that data as well. We still don't have the data for what the median household income is. It still goes back to 23. I don't know why we haven't gotten an update on the median household income wage here in Washington County, but the weekly private wages has gone up 16%. So I know for a fact that people are making more money, and it's pushing them into the little bit higher categories, but I think it's because they're selling homes and they have equity positions to be able to do that. So I think, if I was to look at everything over 750,000 has had an increase in demand.
If you build it, they will come.
So a lot of that is new construction. New construction, but we still haven't built that much new construction, which we're going to get to. Washington County data continued. This kind of is just showing the total number of listings. We're at a high water mark, going really back to like 2017 as to how many active number of listings. But the new listings have been pretty stable over the last 2 years. But you see that big drop off in December of 23 and December of 24. It just happens. So we can kind of project out what we're going to see in the first part of this year, January, February. I know we've already seen the January numbers come in. It started to climb. But then we peak out right around that end of February, March timeframe, and then it kind of has this sliding effect throughout the rest of the year. I don't think there's going to be much change from the pattern that we've seen over the last 2 years for this year.
Yeah, it's like the holidays leading up to the parade of homes, kind of.
Yeah.
That's what it looks like.
So it's going to be typical. So if you're in the market, if you're selling, if you're thinking about selling, it's a great time to get your house listed, but know that you're going to compete against more inventory. So you're going to have more options for buyers to hit the market. But if you look at the sold, these are pending. So the pending and sold numbers look almost identical, but the demand also climbs. The demand climbs all the way into April. So if you're thinking about getting the house listed on the market, now's a great time to do it. We know that there's going to be demand in the market up until we hit the summer. You can see June of 24, it drops off. June of 23, it drops off. Once we get into the hot summer months, demand slows down, where active listings stay pretty consistent. So if you're going to get it on the market, you're definitely going to want to get it in the market in the next couple of months, or if not right now, you know the number to call. You can call us. We'll take care of you. Price trends. So this is just looking at price up and down. So the yellow one is the list price. Always comes in above what ends up getting negotiated down. The orange one is the sold median sale, and the purple is pending. So you can see we have these big spikes.
Parade of homes.
Two big spikes. The total,
and they just keep getting more expensive too.
They just keep getting more. You told me there was like three over 10 million.
First time ever that there's been a house, and this year there's two, but over 10 million. There's one at 10 million, and then there was one like at 10.8.
It's crazy, man.
Crazy. First time.
If you got $10 million to spend, man,
well, the most expensive
houses.
one from last year was 8 million, and it sold like in a month cash.
Dude, I saw a sneak peek of the R.L. Wyman house down in like Little Valley.
That's the $10 million one.
It's insane.
It's like a hotel.
Well, that's
It's
the,
beautiful. It's a absolutely like they built it's a stunning house.
Yeah, that's the one that sold last year. The volcano one that sold was at $8 million.
R.L. Wyman, he does a good job.
he does.
That team does a good job because it's not just one guy; it's his whole team, from top to bottom too. Landscaping, they dial in all the little details. So Parade of Homes coming up. If you want more information about that, we can give you more information. Make sure you reach out to us on Parade of Homes too. But
I'm just going to derail you with another question.
Keep derailing me.
Do you think that when Parade of Homes happens, you see any spillover of like unreasonable expectations in buyers? So like if you go to list your home during Parade of Homes because you're like, oh, there's all this excitement around real estate, so that's when I'm going to list and sell my home. Do buyers also tend to be like, well, this home isn't 100% perfect, and I just went and toured all these $10 million houses, and so now that's kind of what I was, hoping for in my mind,
Here's
subconsciously, and now I'm really like nitpicky as a buyer.
You give yours, and
My
I'll give you mine.
opinion is that the people that walk into parade homes and see stuff like that and or complain like, oh, I wouldn't have done this or I wouldn't have done that. Those people aren't in the market anyway.
No. I'm
But he's
talking
saying,
about
do buyers
like-
when they're looking at houses
like-
have this expectation?
Yeah,
of-
so you just went through the parade and looked at 15 immaculate, perfect homes where every detail is on point, perfectly clean, not a, nothing's out of
Staged.
place, staged. And then, what they're really in the market for, though, is a $700,000 or $800,000 home in Little Valley that's, anywhere from five
these aren't
to
solid
10 years
core
old.
doors.
Yeah, right. Like, and now
This
they're
hardware
just
seems a little janky.
going, or this landscaping really needs to be updated, or the grass isn't perfect, and we'd have to tear that out and do new sod, or just like whatever. Like,
I think
consciously
it's
or subconsciously, do you think it spills over into buyers' expectations? So
I think it does a little bit, but I think actually more so it has their subconscious is the house I have right now isn't good enough. So it almost inspires them to be like, I want something new. I think it doesn't necessarily make the buyers more picky. It makes the sellers more invested in saying, I'm ready to get something new. I think it inspires the sellers more than it does make the buyers picky.
Right, but I have to sit here and advocate for good financial decisions. It's at the core of who I am. And so I think if you're a seller, like that's probably the wrong reason to be selling.
Probably, but I think that's the psychology there. If there's a psychology play going into whether it's a buyer or seller.
It's that sellers are more motivated to unload the stuff they don't want anymore, more so than the buyers
They're unhappy.
are excited to or unexcited to buy it.
Yeah, or buyers are just overly picky because I think people have fairly reasonable expectations when it comes to new construction, I bet you it definitely shifts some buyer perspective on expectations. That I'm going to build a new house. I want everything perfect, right? Like the blue tape walkthroughs where they're like, this miter doesn't like match up perfectly, and those kinds of things. I bet you it probably has some psychological impact. But I think it probably more than anything, it makes sellers more but motivated to be like, I don't want this house anymore. I want to go get something else.
Nothing major and significant though. After like over the years of you guys,
no, I don't think
dealing
so.
with all this. Okay,
but also I think I agree with Jeff too. Is that most of those people aren't necessarily in the market at the moment. There's still some time. There's some lag that goes into. They went and look at those houses, and then it might fire them up to go buy something new, and then like 2 months later, which you could see right here from the sold. Let me look at the inventory. So you have the peak of the pending sales comes in April. The peak isn't in February. It starts climbing in February, but the peak doesn't happen until March and April, right? There's a delay between the parade of homes. So the parade of homes doesn't incite and these are pending. So the pending in March is closing in April. The pending in April is closing in May. Does that make sense? So the people in the market, it's inspiring people to get the selling or buying juices flowing. It's not that in February, that's when all the sales happen. Does that make sense? Yeah. I think there's a delay and lag time in there. I don't know if that answered your question.
Yeah.
We're coming back to vacation rental data. Man, we've been watching this pretty closely. It was actually one of the key features the Kempsey Gardner Institute did their end of the year report, and they were talking about vacation rentals. There's some legislation up in Salt Lake talking about allowing cities to enforce zoning laws. So if somebody's doing a vacation rental in a neighborhood that's not zoned that way, letting off the chains, so to speak, and is to allow the city to
criminally prosecute
it or enforce the zoning laws within it. Because right now there's a lot of hoops that they have to jump through in order to, if you live in Bloomington, for an example. I know, Jeff, you had this issue where that somebody was doing a vacation rental and it's next door. You go tell the city and they're like, well, we need an affidavit signed by the person who rented it, and you need to have all this documentation saying that they are vacation renting it, and it makes it really difficult for the city to stop the behavior. There's some legislation up in Salt Lake, which I don't think is passed yet, but I think it was presented by Neil Walters to stop that and allow the cities to enforce that. But you can see this climb. If you're looking at the data, we've had just a steady climb since March of 22 in number of active inventory. So we've gone from basically 50 homes for sale that are vacation rentals up to 168 active listings. And you can see at the bottom, the sold listings or the pending listings between 25. I think there was only like 18 vacation rentals pended in December 24. Home values for vacation rentals has definitely taken a hit.
I wish we could overlay list to sell ratios on this, because I bet the list to sell from March of 21 to March of 22 would be outlandish.
Yeah, absolutely.
Outlandish.
And a lot of this was new inventory. So this is new construction of vacation rentals. And I think a lot of this is they're still building more vacation rentals. There's still more subdivisions that have vacation rentals that are hitting the market that just really the demand hasn't caught up. So we're seeing it slide from a peak of over 200 active listings down to 168. But if you look back last year in 2022, the end of the year, there was a drop off of active listings. It'll be interesting to watch this year continue, because I think this is going to see a continued upward trend of active listings for vacation rentals, because so many people are not making the money that they thought, because less people are vacationing here than they were post-COVID.
Well, it creates a problem too from a margin call perspective, right? Like if you buy a property expecting to make have a certain revenue dollar, whether it's from occupancy or raising rents or stabilization, whatever. And that changes and you're upside down on the mortgage, right? Or even if you're, flat from a cash flow perspective, but then you start having capital expenditure stuff, right? Because even if your rental's not making money and you're like, man, I'm just like, I'm cash flow neutral. Mm-hmm. Like you are losing money in those months. It's just accruing until the point that you have to fix the roof or replace the water heater or,
They break a bunk bed or something.
Yeah, whatever it is, right? Like capital expense. Anytime there's use going on, like truckers understand this really well, right? When they don't want to take a load just to break even because they know they're still accruing deferred maintenance on their trucks,
And
right?
vacation rentals take a lot of deferred maintenance.
Yes, and so what ends up happening though is at a certain point people go, I have to sell this, right? I can't continue to float this. I can't continue to do this, and so they sell it. Well, once people start selling, it really brings down the value of these nightly rental properties where the premium was being paid in their ability to produce this higher revenue,
future revenue.
In the top line revenue, not the net return, but the top line revenue. And so as those sales happen, my theory is it's going to have a downward pressure on prices for nightly rentals, which will eventually then right. If you bought in 2020 and you're like, well, I have all this capital appreciation, but now the market's coming down on it, I might now jump out and sell while I can. And that's how you have a cascading effect. So the same thing happens in capital markets, like in the stock market. It just happens so much faster because the liquidity is there, the instant pricing.
Yeah,
I think
you click and it's sold.
Yeah, right. I think the same thing's going to happen in essentially this market where the valuations on nightly rentals were so overextended and the leverage was so prevalent. It just takes a longer amount of time in real estate for that to happen and unwind. But I think unless there's a drastic change, it's almost, I think it's inevitable. Now, imminent and inevitable are different.
Yeah.
But
Well, I think the
slowly
adjusted
happening.
value, and I don't have the data right in front of me, but I think the adjusted value, because vacation rentals are so another micro market from one subdivision to another, they might have tons of value, like Paradise Village or Desert Color is an example of vacation rentals. Those values aren't going to take as much of a change in value versus Sienna Hills, where there's not as
the lofts is always an example that I go to, where they
Lofts
were
is a good
selling
one.
in the high sevens, in 2020, 2021, and now the same exact units fully furnished are selling less than 600.
yeah, or
just
just not selling at all,
Or not selling
or
at
just
all.
not
Yeah.
selling at all. And that's the thing is that like
It's a hybrid between residential and commercial, right? You're buying a largely residential property, but you're competing against hotels and the like. And so they're really being priced from like a commercial perspective.
Yeah. So when my point being is that like when you look at, okay, what's the depreciated value or what is the value of property over the last 2 years declined, back to our conversation, is the home values getting more expensive or are they getting less expensive? When you step back from and look at the 30,000 foot view, vacation rentals have only declined about 5% as a market.
Okay.
But the individual listings a lot of times have way worse values today than they did, 18 months ago, 12 months ago. And some, like the vacation rental we have in Desert Color, it was on the bottom floor condo. It has its own unique amenities. It's right across the street from the lagoon and all the resort stuff. And that sold almost immediately, right? And we were priced over what the rest of the market was selling. But the buyer for that one wasn't looking at it for a vacation rental. His job takes him all over the country. So he's here for 6 months and then he might leave for 3 months and then he's back for 6 months and he might leave for 3 months, right? And so he has a job that takes him in multiple different places, and he wanted a place that while he's gone, he could vacation rental it out and make some income off of that property, which that goes back into finding that needle in a haystack of, who is the buyer and what's their motivation for buying, and then the sellers, what's their motivation for selling. If you're taking on water on a vacation rental and you can't weather this correction in the market, now might be the time to sell, but you got to recognize that you're going to have to be competitive to whatever else is on the market. I still believe the long tail value of vacation rentals in St. George, because I think we're going to get less and less vacation rentals. I think the city's going to stop. Multiple cities across the county are going to permit less and less of them, and we're still going to be a destination town. So the long tail value of vacation rental is still going to have value. Think Park City or any other resort town. Long term
value.
Holding on to it, you got to look at it as a 10-year. We got to hold on to this thing for 10 years so we can see the ebbs and flows of the market.
Yeah.
It's a tough hold. So
it's a tough hold.
Make sure you have
you got to make sure you got the money in there.
You got the whole. You got to have the whole plan put together.
Yeah, so this is 30-year fixed mortgages. We just dive a little bit deeper into that. So this goes back to December of 22. So this is basically, this says May of 23 all the way to February 4th You can see the ups and downs in the mortgage rates. If you look at what the expectation is of this isn't my crystal ball. This is the crystal ball of all these other institutions on what mortgage rates are going to do over the next year. It seems like there's a consensus that it's going to land in the 6s. We're at 7 now. What do you, Brandon? I know you have some thoughts and opinions on where mortgage rates are hitting and maybe how tariffs come into play on this. We were talking about this the other day. I was like, don't spill the beans because I want to talk about it on the podcast. How is there some kind of correlation between what we're seeing with the Trump administration and mortgage rates? What do you think is going to happen, or what can you expect?
I think I don't have a crystal ball, so I don't know that I want to make a hardline prediction on this. I'm way more apt to respond to markets rather than try to predict them. However, I think understanding the relationship between how some of these things work together and how their price is worth considering, right? So, in particular, to start, like the first thing is to remember that mortgage rates are priced on the 10-year Treasury,
right?
In general, and that's because mortgage rates in practice are going to have a effective duration more akin to a 10-year Treasury from a risk perspective, and they're also implicitly guaranteed, backed by the government. When you're talking about Ginnie and Freddie and Fannie. Yeah,
and just along those lines, there was a survey done for homeowners. How long did they expect to live in their property? And for basically the last 6 months, because they do it monthly,
sure,
is 10 years. They expect to live in that property for 10 years, which is interesting. It just kind of there's a link between those two things.
Well, it's effective duration is a risk profile of a bond once it's securitized, and that's different than the actual 10-year or maturity period of the bond. And so that's there's maybe some data digging deeper to that, but I don't think that's if anything that would change the way mortgages are priced and increase the rate. If anything, that would be an upward pressure, I think, on rates.
On how long they hold if they stay in their house longer.
Yes.
Is that what you're saying?
Yeah, because it would increase, like in thought, more effective duration risk into the bond. And if all else being equal, the more duration risk you have, the more term premium you need within the bond itself. And so that's why, aside from these periods where there's these inverted yield curves, generally over time, you're going to get more yield or you're going to pay, like the government's going to pay more interest on a 20-year bond than a 10-year bond because you have more duration risk in the 20-year bond, right?
Okay.
So if all of a sudden people start staying in their homes longer and longer and longer, well, that changes that underlying duration risk. And so you could theoretically then expect maybe like mortgages to completely start pricing differently than they have been. I don't think that's really going to happen. Going back to like the 80s, just for perspective, and this is the spread between the mortgage index and the 10-year Treasury, right? So as this is going up, that's a widening. So basically, you're paying more for a mortgage relative to the 10-year Treasury. When this is increasing, when it's dropping, you're getting a better deal. And you can see that right now we're trading like down near historical lows, right? We're in a pretty good environment for people taking out new mortgages, and I would say somewhat of a unfavorable environment for people investing in mortgages. Now, when you look at what's going on in the bond market, you have to remember that bonds are based upon future expectations of growth. They're a risk asset, and it all relates back to what is your expected return relative to other risk assets and other investment opportunities you have. One of the things to understand and remember is that people that invest in bonds don't have the same upside return potential as they do equity investors. And so they need to make sure that they're getting a return on their money, but in particular, especially if they're investing in something that's a longer dated maturity debt instrument like a 10-year Treasury, they want to get a real return, right? So this is like, it's a bad investment principle if inflation is going at 3% to invest in a bond that pays you 2% a year for 10 years, right? You effectively lose purchasing power, you lose money over time. So if you look back to 2006, This just shows, the red year is the yield of the 10-year treasury, which remember mortgage rates are priced on the 10-year treasury. And the blue line is year over year inflation using CPI as the measure. And you can see that generally the red line is up above the blue line. When the blue line's up above the red line, that tends to be a pretty bad time to be invested in bonds. And largely the last couple of years has been, or the last decade was okay because rates continue to fall. However, that fundamentally changed in 2022 when the Fed started raising interest rates. And you can see that the bond market had already started pricing that in. Going back to 2021, when we started in the end of 2020, when we started getting increased inflation prints, right? Like the market started really saying, hey, the government is printing so much money, this is going to cause inflation. And we want to start getting more, paid more for our bonds, or we're not going to hold them, we will sell them. In the end of 23, you started getting a real positive return on bonds. So you were now at least getting a return on term premium that was higher than the inflation rate. And we've largely held steady on that now. So what happens is now let's move into tariffs. If tariffs go into effect and they go into effect in a manner,
That was a long road to get to tariffs, but this is actually really interesting.
There's a lot of complexity here. But if tariffs come in and they stop or halt or significantly slow U.S. growth, right? What that does then is it's going to make this look more attractive than equities, right? It's going to make bonds look, because you're getting a real return in bonds, right? Returns, you're getting a return over inflation, and you're going to get it. It's guaranteed to get paid by the U.S. government in the case of a treasury. And if you think, well, growth is slowing, so equities are going to come down, or the price of real estate is going to come down because people can't afford, like we're going into a recession or a period of significant slowing on the growth, and we're already at extended valuations in equity and all this stuff. What happens is then people go and buy these bonds, right? Like, well, hey, if things are going to be bad for a couple of years, I'll just buy these bonds, and I'll get really. I'm not talking about Johnny and his 401k. I'm talking about
institutions,
big endowment funds and pension funds and this sort of thing, right? Where they invest in a completely different way than Main Street does. But what that does then is it brings the yield on the 10-year down, and so all else being equal, if the mortgage rates are priced on the 10-year. And the 10-year goes down in yield because everyone's buying them, right? There's only so much supply. And so if people want more, you have to buy them. Well, in order to buy them, you pay more for the bond, which pushes the yield down. There's an inverted relationship there. Price of bonds come down. The yields go down, which means mortgage rates come down. Okay?
So what if inflation starts going up, though? Because I know there's a big conversation around how tariffs are going to cause inflation, because if a tariff is a tax on the buyer of the good, and if we're a net importer of goods, we get it from other countries. Let's say a 10% increase on tariffs from China. 10% of everything we buy from China is now being levied on to the American population. Could the assumption, or at least this is what I hear, is that that's going to trigger an increase in inflation. So if inflation starts to go up, are we going to see that?
Look, I'm not a tariffs expert, right?
Yeah, me neither.
I very much
got somebody on here. If you're a tariff expert and you're listening to this, I'd love to chat with you.
If you're an importer exporter,
I might.
We're interested in talking.
I might know a couple of people that are really well versed in tariffs in the institutional world, and I could probably have them on my other podcast.
Yeah.
If that's something that really actually interests people on a deep level. However, what I'd say is two things that I think is tariffs are a turn on, turn off inflationary event. So you turn it on, you have the inflation. Inflation, remember, is not measured on a continual basis, but a year over year basis. So all else being equal, like if this can of soda is $1 today, and then next year it's $1.50, we'd say like, man, we had a 50% increase in inflation. But if the next year it's still $1.50, we'd be like, we had no inflation.
Right.
It's like my can of soda is still expensive. So if the 50 cents is a result of a tariff, and then 3 years from now, whatever caused that tariff, we take the tariff off. It's
deflationary.
It's deflationary. And so then everyone goes, oh, we have deflation. Well, you put it on and then you took it off. It's like,
that's
I
a
don't
good
know.
point.
It's like ankle weights, right? So it doesn't continue to increase the inflation.
You have ankle weights? You use ankle weights, don't you?
No.
Jeff should have used some ankle weights.
Jeff probably put
I'm
them on
just
his. Jeff probably like puts them on his kids.
Yeah, they wake up in the morning and I strap on the ankle weights.
But they are exactly.
If I had
that's a good
5 kids,
analogy.
I'd try to slow them down. But yeah, that's right. So I think sometimes this stuff about tariffs are more about the short-term impact of it potentially slowing the economy more so than the potential impact on inflation.
Good point.
However, I'm also I'm a market technician by nature. And so I look at stuff and say like, when the market's trying to tell me something, am I paying attention and am I listening? And in particular, I think there is an interesting thing going on with commodities. I think that we are in a super cycle of commodities. And in particular, last year wasn't particularly great for commodities. But they are on a potential like technical breakout, and just as sort of an asset class, right?
Buy corn. So you're saying we need to buy some corn?
No. Like
Coffee?
I am not. Okay.
Industrial lubricants?
You have to
Lumber?
only for you, Jeff.
Fun fact: diesel is classified as an industrial lubricant, not a fuel.
Yeah. No one cares there, Jeff.
Well, okay. The interesting thing about commodities is they all trade different. So cocoa trades
Silver?
different than silver, and it trades different than copper, and it trades different than cotton, and that trades different than sugar, and that trades
coffee,
different
blah,
than
blah, blah.
oil.
Fruit.
They're all really their own. Yeah, and that trades different than orange juice futures, right? Like
right.
it's all
Which
it's
is
all
a big
different.
one, by the way.
But if you
orange
look at
juice
them,
futures.
but if you look at them on mass, right, as like an index, like all sort of a basket of all of the commodities or a lot of the commodities, if there is a bias to them sort of going up, and the last year and a half or so has, or even two and a half years has been tough, and they've kind of, what we would say in the technical sense, have sort of bottomed. That is not good for, I think, bond prices. Because if commodities do go up and inflation goes up, you don't want to go back to owning the thing that doesn't have the upside potential, remember, right?
Right.
You want to own the thing that doesn't have a cap to the upside. And you don't want to have the same instrument. So there's a lot,
bottom line,
there's a lot of theory here, but
is if your lender or real estate agent tells you that rates are going to go up or down,
They don't know.
they don't know, and you should
they're probably full of it.
you should call Brandon.
And I'm happy to go through as much as we want, but there's a lot that goes into pricing bonds. And what I would say is, if I go back and look at not this, but let me just pull up. Let me pull up this one, which is just like, so this is not the credit spread of mortgage to 10-year, but this is like the actual just raw mortgage rate. So this is on a daily basis. Let's just, to make it just a little bit easier to see, go to a weekly basis and back this out. Now this index started printing in what was it, like
When I bought my home in 1985,
yeah, like
my interest rate was 15%.
I paid $35,000
yes,
for it.
this goes back to 71, right? So you can see like
Gold standard.
So look, I mean, they only started tracking this index in 71, but interest rates in general, right? Remember, they all kind of price together. Like debt instruments are all very similar. It just has to do with credit quality and credit ratings, length of the bond, all those sort of things. But you can see like rates just have been coming down, right? And there's periods where they came down and they went back up, for a short period of time. But structurally, they've really come down. And the bond cycle should have bottomed in 2008, and rates should have started going up after that. Now, the government chose to artificially hold them down here in this kind of period here post GFC, and then just exacerbated the problem even worse in COVID. Was suppressing the rates even further.
What's the lowest possible interest rate you could have had in 2000? Is it 2.65?
2.65 on the index, which is again going
So
back to
maybe a
Rob's
VA
comment.
loan?
That's like not always like, I'll say my rate's 2.375 on my house.
There's
yes, I have
probably-
a VA loan. So look, this is just the index. Again, an index is not. It's not everyone's
rate.
experience. It's a summation of everyone's,
Rates. Yeah.
experience, right? So,
Mine's 2.65, funny enough.
wow, Jeff, you nailed the bottom of the market.
Well, I don't
So-
have a VA loan.
So,
But my point is, I look at all this and then I look at the structure of the whole market coming up here. And I think that, look, if you get a rate around 6, I think that for a long period of time, it's going to look like a relatively attractive rate. And I think that the bias is to the upside, right? The bias is for rates to be higher. I'm not saying there isn't a period that they can come lower. And I think you saw that in this period when in, going into 24, everyone thought rates were going higher and they largely came down over the rest of the year. Right.
So, I mean, there were plenty of,
but now they just shoot right back up.
They're ping ponging around this. And I take it from a real estate agent perspective is we don't want home values to keep going up as fast as they were. Right. Like we're looking at
healthy.
Yeah, it's not healthy. It's 65% appreciated value over the last 5 years in Utah real estate, 65% in 5 years. It's just not something that's sustainable. And so the rates are one factor of it. And then the values of the house are this other factor.
There's a lot of factors that go into it. And some of it is quality of life too, that you can't even quantify.
So if you're waiting for a rate to change, I think my biggest point is like, if you're on the fence in 2025, should I buy or should I not? And am I waiting for a rate? The reality is that you're waiting for the wrong thing. You're getting lost in the forest for the trees. That if anybody tells you they're going to go up or down, they're not really 100% sure. They're probably not even 50% sure, barely, right, as to what exactly it's going to look like. And so you got to make the best financial decision for yourself. What makes the most sense for you right now? What can you afford? And you go find a house that you can live in and be happy in. And be careful with your investments in real estate because it
can
be a lot riskier than what
it's riskier today than it was 5 years ago.
Well, yes, and yes. And I'll say that I'm probably one of the most qualified people in Southern Utah.
Don't break your arm patting yourself on the back there.
No, from a professional standpoint, right? Like
I probably agree.
to try and list, like I'm not saying I'm the best financial planner or advisor. I'm saying like from a qualification standpoint, I'm one of the most probably credentialed people in Southern Utah to try to time markets. And what I'm telling you is if you need to buy a home, it's very, very tough to time in markets and you likely cannot do it. So make a prudent overall decision that you can live with long term. And stick to the long term because like the old adage is time in the market versus timing the market,
right?
And if something is the longer your time horizon, the less the timing sort of matters.
Brandon is the only certified market technician in the entire county that has CMT 1, 2, and 3. Shout out to Brandon.
Appreciate it.
It's true.
I'll drink to that.
It's facts. I'm shooting straight facts.
So yeah, look, I'm If I can share one more thing to your point about it being riskier than it was 5 years ago, and why people really should have.
You're not sharing anymore, but
what? Let me share.
Do I have to help you share? Or you just share.
Send requests. You gotta stop sharing.
You gotta stop sharing.
Someone else is sharing.
I'm stopped. I stopped.
Okay. All right. Look, here's the Bank of America high yield index. Or
last thing before we lose everybody.
Spreads. This is credit. Look, this is credit spreads. So this is a graph showing if I have money and I'm going to borrow it to people, and I have the choice to borrow to Jeff with an 800 credit score, or Rob with a 500 credit score.
That's probably true.
Okay. I am going to go, like, if I have $1,000, I'm going to say, Rob, I want, 15% a year from you. But Jeff, if I borrow it to you because you have an 800 credit score, I'm going to give it to you at 8% a year or 7% a year, right? Like
my number's bigger.
That's
how, go with mine.
That's how credit normally should work, right? In a functioning market, that's sort of what happens. What happens is as markets grow and expand, you have more and more money. So now if I just have $2,000 and there's only two people wanting to borrow money, and Jeff's like, yeah, I'll borrow money at 7%. And I'm like, Rob, I'll borrow you money. And you're like, I don't really need money. And you're like, well, how cheap do I have to borrow it to see that you are just incentivized to want to borrow it? Mm-hmm. Because I have to get it borrowed out because I need to borrow it out so that it's working for me.
Right.
So eventually it just gets to a point where you're like, you have an 800 credit score, Jeff, I'll borrow it to you at 6%. Rob, you're paying 6.5%. And it's like, I'm not getting compensated truly as an investor the same way that I should be for the amount of risk I'm taking. But that is how it's just a result of things being as good as they are for as long as they have been, sort of deal. And so what that difference between, Jeff's rate and Rob's rate is the credit spread, mm-hmm. right? And if you go back and look at the Bank of America's index on option adjusted credit spreads, And you see right now we're down at 2.71. And if you go back, the only time in history that we've been tighter on credit spreads than that is right before the GFC, right? So I'm not here to
The housing market crash.
yeah. Look, I'm not here
Subprime
to
loans, that
like
kind of
ring the
stuff.
bell and just say like it's all going to crash. I don't think it's all going to necessarily crash, but to your point, it is becoming riskier and riskier, right? Like the longer you take to get invested, the more risk you theoretically have as it gets closer to the next correction.
Yeah.
So
It would be interesting to dive into why we think this is, which we're not going to cover right now. But I think there's got to be a lot of different functions as to why this credit spread is so small.
well, it's just there's so much money chasing
So few people.
so few loans,
Yeah.
and in particular in public markets, right? I mean that this is obviously based upon public markets, but it's a good bellwether of the overall financial conditions of the country. And when it's tight and when it's getting tighter, that is a good sign for prices in general, right? So as it's been getting tighter, like if you go back and look, man, real estate prices have shot up. If you have a 401k or you've been holding stocks, like chances are you've done really, really good the last 10, 15 years, right? Since spreads have been tightening. Problem is when they blow out, it's because they're worried about a default. And again, you're going back to an instrument where you have no upside, you have no like real upside in the equity value of it. But you have a limited, but you're promising it repaid.
Yeah.
But if the promise to get repaid goes away because of bankruptcy and defaults, then you want to try to unload that as fast as you can and get what you can out of it, so to speak. And
Right.
so that's why, bond markets crash the same way stock markets crash. It just happens that the bond market typically crashes first and in the high yield space. And that manifests in credit spreads re-widening because people are like, my gosh, I'm not going to get this. I'm not going to get my $1,000 back from borrowing it to Rob. Jeff's fine. He's going to pay me back. He had 800 credit score. Rob had 500. So I borrowed you $1,000, but if somebody's willing to give me now $600, you can take over the loan with Rob and I'll just be out, right? Like that's a 40% loss of your money. So
That's a good point. Okay.
Anyways,
That was a helpful overview as to there's a lot of functioning pieces going around with interest rates. I think if you followed along with that whole thing, you'll get more of an idea of. I don't think there's going to be a huge swing up or down with interest rates over the next 12 months. From my perspective on what we're seeing, Brandon, I don't know if you'd argue with that. The crystal ball tellers, Morgan Stanley's, and all these credit institutions say that we're going to probably run around 6%. Low sixes is going to be the interest rate for the remainder of the year.
I think you're going to be hard pressed to get a rate better than 6, and I think the bias is to the upside. I don't where it ends up and when that happens. I don't have a crystal ball. It would be challenging for it to get below 6 in my opinion.
Okay, we're going to jump in. We're going to do rapid fire because we only got a few minutes left. Platted lots, 10% higher than in 2023. So we got platted lots. We got investors that are going through the entitlements process in getting platted lots. We had a bunch hit right in February of 2024. We'll likely see a bunch hit in February of 2025 as well. But yeah, platted lots are up. December new home sales, highest number as a percentage of the year. So a percentage of the total home sales, we had 37% of the market was new dwellings versus the total dwellings. There was 6,500 total dwellings sold in Washington County as per the recorder, Southern Utah Title Company reports. So the county recorder, the MLS only had like 4,700 or 4,800, I think is what it was. But total dwellings for sale by owners, stuff that wasn't listed on the market. So 6,500 total dwellings, 37% of the market in December was new dwellings. So new construction, going back to kind of what we talked about at the very beginning with you, Brandon, is new construction, I think, is driving a big portion of that home value appreciation, where you have the older inventory is selling for less money. New inventory is getting a premium on the new construction, housing costs, building costs, all those things. Lots, dwellings, acreage, and commercial did pretty well this year. Commercial values in 2024, just lots and dwellings up over 2023. So all the dwellings were up 19%, lots up 53%. So a lot more land moving, acreage about the same, little changed. 12 commercial. I don't know how accurate that is. 12 commercial properties. I'm not sure about that number, but Southern Utah Title says that we're up over 2023. So we got more demand in the market. This is the home appreciation forecasts. This is average of all 22 institutions, 2.7%. This is as a U.S. housing market forecast. So we got AEI Housing Center says a 5.5% appreciation, where Morgan Stanley says we're going to see a 2% depreciation of home values across the country.
Someone at Morgan Stanley is about to lose their job.
Moody's has it as basically no change. Freddie Mac 0.6%. So I think the appreciation values, if you're looking at the macro, this is all of the United States across the board. It's kind of 2.7%, right? There's not going to be a huge appreciation. Yeah, but I know Texas.
The consensus stuff is always BS.
Yeah, I think so too.
It's
a fun number to look at.
Well, if you get in the institutional world, it's a game of over under slightly. So here's the deal: is the guy at AEI Housing Center, he's about to get fired or promoted, and the guy at Morgan Stanley is about to get fired or promoted. Yeah, and everyone else in the middle, their job is safe.
Yeah, it's a good point. That's a good point. Home prices. This is a percentage value year over year. Going back all the way to 1954, you can see a huge jump. We dropped significantly. So if you look at the housing bubble, September 05, we were just at a 14% annual year over year change, and we started to crash all the way through September of 2009 at the bottom at a 12% depreciated value. Remember, we were building homes in Washington County. They were issuing out $1 million of basically open credit. If you had a real estate license and you wanted to build a spec home in Washington County, you got $1 million credit to go build a home. We were letting people and anybody with a pulse build homes in the country over the course of 2005 to 2006, which caused a big portion of the market crash.
I thought yeah.
I
don't know the pulse because that's all it's pretty much required to get a real estate license. Is that
yes, absolutely. I'm glad you said that.
Hey.
If you Jeff's offended, I'm not. The reality is we had over 10,000 homes on the market in 2008. 2007. It was like right before the crash. We had 10,000 active homes on the market. We had over 10,000 homes on the market before the crash, which is why we had such a massive.
If anyone's trying to conceptualize how large that is, the entirety of the Long Valley project, once it's completed, is supposed to be 2,500 homes.
Yeah, exactly. Like, I mean, we're selling 6,500 homes a year total, and we had 10,000 active on the market before the market crashed.
That's 5 times as many that's active right now.
Yeah, it's
on the MLS.
It was insane. So if people are comparing this time and last time, everything is completely different. We can't keep looking back at that. But what my biggest thought was the pandemic housing boom. We went up 21% year over year as of March 22, and then we dropped significantly. We had a depreciated value or just basically a no change by May of 23. As of 2024, all of 2024, we had a 9.5% appreciated value from May of 23 to the end of 2024. So that being said, we dropped in value, but we're headed back up. Annual home sales, total new homes sold, 15 years below, 696,000 homes sold across the country in the 15 years, and that's below the average. I'm sorry, the average homes sold, number of homes sold across the country over the last 15 years is 696,000 homes. We sold 682,000 homes last year, so right at about the average. If you look back before the housing market bubble, 2004, 2005, 2006, they were selling significantly more, double homes, the number of homes sold. This is actually puts us right around what was going on in the 90s.
Well, that's because borrowers could buy 2 homes or 3 homes at one time.
Exactly.
Pretty easily.
Or investors were owning several homes and they were trying to spec them out, right? Just kind of like what I was just explaining. Existing home sales over the course of 2018, 19, 20, and 21, we had 27 million homes sold, where 2002, 3, 4, 5, and 6, we had 32 million homes sold. We've dropped significantly. The green line is percentage of the households per sale. So we're down to 3% of the total households in the country sold in 2024. The lowest number since going back, I think this is back all the way to the 70s before we had that few as a percentage of the homes. Going back to what your question was, is it causing people to stay in their home or not? I think interest rates, people are staying put, and millennials are bunking up with mom and dad. Utah annual home sales by year, we had more home sales in 2024 than we did 2023, still under 22 and far below anything else going all the way back to 2014. So definitely a correction in the annual home sales. Demand is low, but we're seeing an increased movement in demand. Median home payment. This is the big chart. This is where everybody gets pain, right?
Insanity.
You see the yellow line here is interest rates as they jacked up. The median sales price goes up, and the average home principal and interest with a 20% down payment was $2,500 a month. Is it cheaper to rent or buy a home right now, boys? In Washington County, it's cheaper to rent. It's cheaper to rent, which, over the course of almost all of the last 30 years, that was not the case, but that is absolutely the case.
But aren't you supposed to?
No, that's up for debate. What's the total cost of rent versus the total cost of ownership? Net, it's been a better solution to buy the last 15 years, regardless of initial payment. Payment perspective might have been cheaper to rent or cheaper to buy. Well, but it could have been more expensive.
You don't got to pay taxes. You don't got to pay for repairs, deferred maintenance, all those things. I think right now, you're right. Over the last 15 years, it was a net better decision to buy. However, in the last year, that has not been the case, right? The math is truly working against you to buy a home right now.
But aren't you supposed to marry the house and date the rate? Isn't that what you're supposed to do?
That's what all the new agents say. That's what all the new agents say and the lenders say. Yeah. Don't do that. The point is if you're going to buy a house, you buy it for specific reasons, right? You buy the house because you want to plant yourself in that community. You see a long-term perspective on it. You have proper motivation. If you plan on living in a place for only the next 1 to 2 years, you would likely be better off renting. And it's a conversation we'd love to have with you is to flush those things out. Home flippers are the real estate equivalent of day traders. Exactly. And it's tough.
100%.
It's tough.
It can be done.
It can be done. There's a much higher risk today than there was last year or 2 years ago.
They say if you can win 70% of the time day trading, then you'll be all right.
Oh, you'll say
30%.
You'll be loaded if your accuracy 70%.
70%. Okay, I think this is the last thing before we wrap. Back in quarter 3 of 23. Okay, so this is just a year plus ago. 89% of mortgages had interest rates of 5% or less. Okay, so in 2023, quarter 3, so October of 23, 89% of all mortgages had a 5% interest rate or less. As of quarter 4, 76% of mortgages are less than 5%. So we've seen a massive 13% change. People are still moving. They're not staying put as much as that is the theme that tends to be happening. For sure, the market is definitely shifted. People are moving for reasons that are outside the interest rate. But a big portion of the market has under a 5% interest rate, and I don't think that is going to change. It's not going to change. If you have an interest rate over 8, call us. You should likely refinance. Now's the time. Don't wait for it to change anymore.
Whoa, it's a big statement.
It's a big statement. If you have an 8% interest rate, you should look at what does a refinance look like? Because back to our point before, what are we waiting for? A 5% interest rate.
Don't call the company that mails you stuff either.
Yeah. Call someone local.
Gravy.
Okay, that's a wrap, gentlemen. Anything else you got for us? Thanks for tuning in, everybody who listened to the whole episode. We enjoy doing this for you every quarter.
If you listen to the entire episode, call us for free parade of home tickets.
Yes. If you listen to the whole thing.
If you listen to the whole thing.
If you listen to the whole thing. That's beautiful. I like that. I'll do it.
Also,
call us.
Let us know who we should have on the podcast and what we should talk about.
Yeah.
Give us some ideas.
Keep sending us ideas. We got lots of ideas, but send us who you guys want to hear from. Until next time, guys, we'll see you out there.
Bye.
Thanks for listening in. If you enjoyed this episode, please like and subscribe. Make sure you're following us on all the social media websites. We love your support. We love the dialogue. We want to continue that going.
Find us at realestate435.com. We'd love to help you find a house here in town or help you get wherever you're going.